U.S. markets are, of course, closed today as our American cousins get ready to stuff themselves full of turkey, probably watching football right now. But we here in Toronto, we're open and we're pushing towards the closing bells on Bay Street. Well, our next guest says end-of-the-year markets will be choppy, and they're going to test our resolve. For more, we're joined by Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management in Toronto. Diana, always so good to see you.
Thank you very much for having me.
So let's talk about this testing of our resolve in the last month of the year. How are we going to be tested?
Greg, I think that end-of-year markets, we only have about 25 trading days left. I think that most of the time we've had, for the most of the year, we've had very bifurcated markets. And so there's a lot of very consensus trades that have worked and lots of trades that have not. I think that the last month of the year will be mostly not new investments, not new portfolios, but more profit-taking versus tax loss selling. So that creates a very volatile and choppy type of market that might test the resolve of those that have won this market, particularly those that have invested in the right sector. So there could be a little bit of a reverse trade. You see energy, mining, and Canadian dollar type of trades long as people take a little bit of profit taking off of the winning trades and put them into stuff that has not been working or that have been some short covering and tax loss selling. So generally speaking, in that context, we are positive on markets. I'm saying it will test your resolve, as if you are on the right side of the trade, it might be a little choppy and you might question yourself whether you're still right.
Now, when you talk about profit taking, I don't think of too many days with green on the board, and definitely that's what you're saying, that investors need to sort of look through that and into the new year. So where do you see the trade in the early part of next year?
We are very disciplined in how we look at the world. Our models are positive. Our models are still showing that in those sectors that are working, we're still continuing to be there. What we like is we continue to like the consumer discretionary. In the consumer discretionary sector, you've also had bifurcation within the sector. So for example, bricks and mortar retail has not worked at all, whereas internet retail has worked. We continue to stay with strength. We recommend you continue to stay with strength. And if that trade reverses itself over the course of the next couple of weeks, just on profit taking like we discussed, do not let your resolve be tested.
Now, before we can get to the holiday season, and hopefully you have some time off, I got a little bit of time off, we got the Fed. We got to get past that. Market right now pricing in a pretty good chance that they're finally going to hike. Are you in that camp, and what does an investor do with that information?
You know, the interest rate hike is a very controversial subject. Generally speaking, rate increases tend to hurt markets, but not at this level. Not when we're going from zero interest rate policy for so long into a situation where the Fed might feel that the market can handle a little bit of less accommodation. We're going from very, very low to very low. And I think that we're going to want to see that the market's holding on. People are talking about the strength of the US dollar might be hurting some of the profits. But you see the large cap and the bifurcation of the market. What it's telling you is that these companies are able to withhold and withstand a little bit of less accommodation. And plus, we have a lot of accommodation elsewhere in the world. So relatively speaking, I keep saying this, but we are the U.S. is the cleanest shirt in the laundry.
The cleanest shirt in the laundry. The Fed and all central bankers, they love to leave themselves a side exit. They were out, they did their publicity campaign, the different presidents of the regional banks, all pretty much juicing us up for this idea that they're going to raise rates. What knocks them off now? It's got to be something pretty big to knock them off that course.
You mean the Fed?
For the Fed, yes. Yeah, the Fed.
I absolutely agree with you. I think that they have been very, very transparent in communicating, especially in the last 2 weeks, after the data has given Ms. Yellen the data that she wanted to see. She's pretty much communicated quite clearly to the market that rate hike is probably in the cards. So no one is going to be surprised. And I think that markets being the leading indicator, stock markets are your best leading indicator. I think it's telling you that it's already priced in and it's okay. It's the next year that people are worried about. What you have is also a differentiation in opinion. Some people are saying that it's going to be a one and done, and others are saying it's going to be 3 or 4. Frankly, if it's 3 or 4, it just means that the economy is doing better, which will be supportive of a lot of things.
I think the key will be for the media to find a snazzy rhyme there. One and done, 2 and through. If it's 3 or 4, we're going to find something else to rhyme. 80% of your investments, I understand, are in the U.S., so obviously that's a good scenario for you if the markets have already priced in the Fed hike.
Yes. We are. We're very disciplined, and if you think of us as a heat map that rotates out of relative weakness into relative strength over the last 18 to 24 months, that strategy has rotated us out of Canada, out of the less strong sectors such as energy, mining, and so forth. We do have our exposure to Canada does lie in specialized situations. We do have a couple of the Canadian banks which do report next week, and but yes, 80% or so is in the U.S. with some of that currency exposure hedged back a little bit to the Canadian dollar at this point.
Well, fascinating stuff. Always a pleasure to talk to you, Diana.
Thank you very much.
It's Diana Avigdor at Barometer Capital Management.